Thank you, Devin.
In order.
Let's see, Liz, come join us.
Oh, there she is. I think you're last.
Okay, so what we want to do over the next hour is essentially think about some of the past of platforms and then talk about the research agenda, both from an academic point of view, but also applied. And so first what I want to do is just a quick overview of the program today. So we've got our review and forecasting, and I'll take a quick moment and just let everyone introduce themselves briefly. So I'm Jeff Parker. My day job is professor of engineering at Dartmouth College. My summer job, or throughout the year, is I'm also a fellow at the MIT Initiative on the Digital Economy. I'm a visiting scholar at MIT, which is sort of funny because it's been since 2011. So visiting has an interesting connotation in an academic sense. So with that, Peter.
Sure. Peter Evans. I'm the managing partner of the Platform Strategy Institute. I went to MIT. I did my master's and my PhD here, so it's fantastic to come back every year and see all the new buildings and everything that's taking place here. So it's great to be here.
Liz.
Good morning, I'm Liz Altman. I'm a professor at the University of Massachusetts Lowell in our Manning School of Business, also MIT alum, and also guest editor on the future of the workforce for Sloan Management Review.
So Marshall Van Alstyne, I'm faculty at Boston University and research at MIT and play with platforms. Been doing that for a little while.
And a little while is not a single decade. Okay, so we'll have Alex Ng join us at 10:15, and then we're going to have Svenja Falk, and you'll introduce your panel on the new digital divide. At 12, you can see there's a fireside chat with Bruce, who went to Martha's Vineyard last weekend, evidently socialized a lot, and is now down flat. So what we're going to do is invite him back next year, and we'll give a little bit more time to the other panels. Then we'll have an NFT presentation from My Learning, NFT, and then we'll have a number of panels. So we've got the platform powering enterprise talent, we've got Web 3.0, we have the future of the retail experience, and then I'll do a fireside chat with Joanna Rotenberg, president of the Personal Investing Group at Fidelity. And then because we're in this beautiful space, I thought we'd be remiss not to invite Dava Newman, who is our director of the MIT Media Lab, to share some of the research agenda and how that dovetails to digital transformation and platforms here. And then perhaps a beer or a glass of wine will follow. So that's the day. In terms of the event, we launched this in 2013 because, I don't know, I'd say we were platform evangelists. We really thought this stuff was cool, and have thought that for a long time. As Marshall alluded to, we've been playing with platforms for some time, and it really started with a pricing puzzle. We were sitting around having coffee in the late 90s at MIT as doctoral students, lamenting that all of our favorite television shows kept getting canceled. And the reason, of course, was that we were interested in idiosyncratic niche content. And the mass market ad-sponsored network business model didn't actually support that. Now, of course, it does. We've seen that with Hulu, we've seen that with Netflix and Amazon Prime and a whole explosion. But at the time, it didn't. And so that little peak started us thinking more about the business models, and those were pretty well understood in news and media. But on the software side, not so much. So those of you who are old enough remember spending $500 for a box of diskettes for Lotus 123. Come the internet era, you got high quality software for free. Now, obviously, it wasn't really free. Somebody else in the system was paying, but there had to be some way to capture the value of all those free users. And that required a modification of the theory of network effects. And that's really where two-sided network effects came from. Now you had some others looking in credit card markets, like Jean Tirole over in Europe. But Marshall's and my kind of angle at it was more from the software side. And so we were really interested in computer game consoles and software applications, and that required some new theory. And so that's sort of, as young academics, what you're supposed to do. Fast forward a little bit more, and you had this kind of dot-com crash. So you remember, this was actually in the late 90s. And that just cleared out a bunch of terrible business models that just didn't work. You know, boo.com and other things. All you had to do was add .com, and you could raise an IPO round and cash out and go to the Cayman Islands or something. But what that did do was lay the landscape for business models that actually made sense. And so that then set the stage for the emergence and ultimate kind of huge growth of firms like Amazon, Facebook, Google, and then the resurgence more recently of Microsoft. So that was where we came to it from looking more at the strategy side. And so that would say it'd be around 2005, 2006, 2010. And our prediction was this was important. And so we felt like the riders on the horse going, the platforms are coming, the platforms are coming. And everyone's like, yeah, tell me more about finance. Tell me about that, mining operation. Let's talk about oil and gas. Let's talk about the real economy, where people poke holes in the ground and they suck out hydrocarbons. Not that those aren't important, as we've certainly seen in events in Europe, but nonetheless, the platforms were truly coming. The business models were different and they were important. And that was our thesis. And we felt a little lonely in the wilderness hollering that. And so honestly, part of the reason we launched this event was to provide a forum, if you will, of like-minded people who we could then reassure ourselves, we're not crazy. This is actually important. These business models are real, and they will have significant impact on the global economy. Now, of course, that's certainly true. In terms of the sectors that we've seen that impact play out, we've had topics ranging from energy, healthcare, publishing, commerce, communications, computer games, lots of industrial internet, kind of web infrastructure, e-commerce infrastructure, music, and the entertainment economy. I mean, the impact is kind of across the board. And what this forum has allowed us to do is essentially provide a place for the very people who are doing this work of digital transformation, of building platform business models, bringing to life our belief that the world has changed in fundamental and irrevocable ways, and allow us to learn from you, you to learn from us, but most critically, for you to learn from one another. So that's what this forum is about. And so if you look over the 10 years, we had firms like Thomson Reuters, Mercateo, Pearson, Salesforce, our colleague Sangeet Chowdhury joined us. So that was a relatively smaller event, and we actually held it in the smaller room across the way, similarly with 2014. But now we're starting to get a little bit of momentum. We had Ming Zheng be brutally honest 3 weeks before an IPO. That was remarkable. The comms person evidently was asleep that day, but shared some really important insights about the way that they thought how to manage competition. Upwork, a critical company that has sort of laid some of the foundation for labor markets in online environments. And then we're starting to move into some of the more infrastructure issues, but we had an awesome presentation from Louis Van Aan from Duolingo, the founder of all those CAPTCHA things. And his hilarious line was, how do we get people to do work for us, translate things for free, and make it a game? And that's ended up happening. And then 2016, I think, was a bit of a turning point. Now, obviously, for us, we were pretty excited about the book that we wrote, that we tried to explain our views on these things. But I'd say it was also the moment where we no longer had to be crying in the wind. It's where everybody believed us. And that's because you could see the explosion of the tech sector. You could see the power of these business models, and they essentially emerged on the global stage. And at that point, we didn't have to convince anybody. And so then we continued, And we had major firms. We started attracting the finance side. We had Dana Murfeld from GE Research, now is CTO, I believe, at the wind energy. Schneider has been a recurring presence, and we've certainly enjoyed that. Tencent, Schlumberger, you can read the names. 2018, I think what's important to point out here is that we're not only bringing the people who have to deal with the transformation, but we're also bringing together the people who kind of led the way in the vanguard. So for example, you've got Airbnb and Uber, who people like to point to, but you've also got firms like Siemens, Rolls-Royce, Kaiser Permanente, Sanofi, and many others. So you've got sort of both sides of that equation. 2019, we started actually thinking about policy, and I think it's really interesting and prefaced. We had Chris Krebs, who was not globally famous in 2019, but it was his job to oversee the security of the 2020 election in the wake of the interference that had occurred in 2016, and really pulled off one of the most secure elections ever, despite the following noise. But this was a forum that we were able to meet some of these global players. And then in 2020, we of course had to do the pivot, and the pivot meant online. Peter introduced us to the idea of online music, which actually was really fun and worked out well. We continued that in 2021. And again, we had, Alice Pisano joined us. SongTrader was a firm that Peter's worked with that helped bring that to life. In addition, of course, we had firms that are kind of managing some of the most interesting transitions, for example, the fuel to the EV vehicle infrastructure. In terms of emerging trends, my colleagues are going to cover that. But of course, we've got Web 3.0, issues of regulation, labor markets, lots of sector growth. I'm working in a number of these topics as well with co-authors both on the stage and across the world. But what I want to leave you with is kind of a circle all the way back to the beginning. And it's really where Marshall and I began this story. You know, the economics matter. At the end of the day, they're going to drive the business models. You can tell stories and you can do pattern recognition, but we fundamentally believe that it's better to dive a bit deeper to understand the physics. What are the moving forces that create the frameworks that allow you to make powerful predictions? And so just to give one example, the network effects that we saw so powerfully in the B2C world arose because of a drop in transaction costs. Those transaction costs fell like a rock because of persistent and ubiquitous network connectivity, cheap computing power, cheap storage. For a variety of reasons, the village market that always had network effects but couldn't extend beyond one day's transportation with an ox, then became global markets. Well, that hasn't really played out in the B2B world, but my hypothesis is that the people in the room are working on driving those transaction costs down, and I can name some of them, Peter, for example, and Angus. Folks in the room are working on that precise problem, because anywhere you see the high transaction costs, that's an opportunity to then start to make these business models that rely upon network effects more salient, because that then allows the network effects to become the broader part of the value proposition. So with that, I'll just leave that we are going to rewrite the book. We're in the middle of that because, look, the world's changed in the 6 or 7 years. So we have to add a B2B chapter. Marshall's taking the lead on regulation. We're putting in examples that need to be updated, and really a top to bottom. And so we look forward to sharing that with you all in 2023. Thank you.
Let me introduce.
Oh, where's the, we lost the cover page. Okay. Good morning. Not quite as good as my undergrads. Try that again. Good morning. Hello. It really is a pleasure to be here. Sorry if I'm in front of my colleagues. I was thrilled to receive an email from Peter asking me to join them on stage this morning. I remember 10 years ago actually being in this room when this event started, and had to look twice when I saw it said 10th anniversary. So again, I'm Liz Altman. I'm a professor at UMass Lowell, and I'm doing some work on the future of the workforce. And this work is joint with Deloitte and with the Sloan Management Review. And in 2020, I received an email from an editor at Sloan Management Review saying this isn't, he actually started with, this isn't a marketing note. Kind of, we know who you are, and we're doing work on future of the workforce, and we're wondering if you'll join us. And we had a conversation, and I said, you know, future of the workforce, I've read what you've written so far, and it's quite HR-centric, and it's very much about inside a firm or inside a company. And though I've taught HR at West Point, I teach strategy, and you know I'm a platform scholar, right? I study ecosystems and platforms and interactions. And he said, no, we know, right? We think that there's a link here, and we think it would be great if you joined us in this discussion. So we started talking about what do we mean by the future of the workforce. We had a bunch of brainstorming sessions, and it became clear that even we were having trouble really getting our hands around what is the workforce. So then we started doing interviews, and I interviewed, for example, the head of HR at Walmart and the former CEO of the consumer division of Amazon, and a couple of Army generals, and some entrepreneurs, and others. And as we were having these conversations in the beginning, I would say, before we get started, let me just ask, if I say workforce, what do you think? And immediately they would say, and if you read our articles, you'll see we start with this a couple of times, that is a great question. You know, we had a meeting about that this morning, right? We've been talking about that because, as it turns out, it's today, circa 2022, it's a relatively complicated question. So that's what I want to talk with you about today and tell you a little about this research. So obviously workforces, and of course tie it back to platforms because that's the interest here. So obviously employees are a big portion of businesses today and organizations, but increasingly contractors, freelancers, and gig workers. And we have some data, but I will tell you that while this has always been a factor, it used to be kind of tip of the iceberg. Now, across industries, across companies, we're hearing 30 to 50% as rough and tough numbers of the percentage of a contingent workforce. So now you have organizations, and not only that, and the print is too small, but they're very highly skilled workers who are part of this contingent workforce. So here you have an M&A expert, you have a product developer, you don't have people just filling in unskilled gaps, but you have very highly skilled, and it's not only technical, it's technical, marketing, management, et cetera. You have subcontractors, Amazon, often if you're gonna have a delivery from Amazon, it's by some mom and pop entrepreneurial group that is now contracted to Amazon. We have complementary businesses, so, and much of the research and discussion around these topics often kind of ends with gig workers or ends with contractors. We've expanded the discussion to say, no, look, if you've got a smartphone, how many people in the room have a smartphone that the only apps on it are those that were delivered on the phone? Right. So everybody has a smartphone these days where somebody else did some work, somebody outside, not Android, not Apple, did some work that made the product better, right? You could argue they're part of the workforce because they made the product better, they delivered value, right? Same thing, Amazon, if you've ever bought something from an Amazon seller, that seller essentially is doing work that benefits Amazon, right? They're part of Amazon's workforce in an extended way, right? And when we talk about future of work and future of workforce, we often talk about, you know, the robots are coming or the automation discussion. So our research isn't specifically about AI or robots or automation, but we can't have the conversation without talking about what is the role of chatbots, of of robots, of other technologies, of algorithms, and also all the issues around algorithmic bias, et cetera. Actually, I'll put in a quick plug because I'm not going to talk about it here much. All of the discussions around ethics, around social responsibility, labor laws, regulations, all wrap into this conversation, and they vary dramatically by geography, and we're very well aware of that. So I'll just give you a quick anecdote. One of my favorite interview moments was as I was talking with a gentleman who's quite senior at NASA, and he said, well, this, again, interesting question. We have had to give our chatbots employee ID numbers. And I actually thought he was kidding at first. And so I said, wait, what do you mean you've had to give them employee ID numbers? And he said, well, they need access to data from our systems. And the only way you can get access to data from our systems is to have an employee ID number. So we don't actually issue them badges, but we do issue them employee ID numbers. And so that, again, makes you step back and say, okay, if they've got employee ID numbers and they're accessing very sensitive data, to what extent are they members of the workforce? And you say, well, they kind of are. Right? So we came up with this definition called workforce ecosystems. And I'm going to unpack it very briefly, and then I'll tell you where you can kind of learn a little bit more. So a structure focused on value creation. So we realized that fundamentally, this is about creating value for an organization. Right? It consists of complementarities and interdependencies. I'll come back to that in a moment. It comes as actors from within the organization and beyond. And my first slide was about employees, and let me just say, this is not only about external actors. Right? We have one of our co-authors works for a company that does talent marketplaces, and the rise of talent marketplaces to increase fluidity of movement of employees within organizations and a movement to more project-based work is a real phenomenon. And platforms being used within organizations to help figure out who should be doing what and where is absolutely a real phenomenon that we include under this umbrella. And working to pursue both individual and collective goals, we know in our platform research that figuring out how to deal with the goals of external participants as well as internal is essential, and so we incorporate them here. Complementarities, some members, as I said, have to do with apps, for example. Interdependencies basically means we succeed or fail together. Okay, so very quickly, January 2021, we came out with our first article. It's a very short article. It's on Sloan Management Review, and it talks about shifts that are affecting this. I will tell you also, this trends in this way were happening before the pandemic, are happening through the pandemic, and we believe they'll be happening after the pandemic. So this is not purely a pandemic discussion at all. Some of the shifts, the changing nature of work, increasing recognition of the complexity of managing workforces, et cetera. We then did, in April of 2021, a full-blown research report with a large global survey. We also have an interactive online that you can see all of our data and play with the data. It's kind of fun if you want to be a geek or not be a geek or pretend you're a geek, but it's there. And then in 2022, in May of this year, we took our definition and everything we've learned about identifying these and said, okay, that's all well and good, but how do you manage them? What does it mean for leaders? And we've started to then push the envelope on what does it mean to orchestrate a workforce ecosystem. Right? And similar to my colleagues, I have a book coming out with co-authors in 2023 by MIT Press, pushing this notion of what does it mean to, what is a workforce ecosystem, what does it mean to orchestrate it. So the research was a global survey, 4,000 managers, 129 countries, 29 industries, 19 thought leaders. We say thought leaders, you'll notice, they were CEOs, but as I said, generals in the army, entrepreneurs, investors, and others, because we really think it's important to think about all the different stakeholders. Some quick data. 93% of managers say that, yes, contingent or external workers are part of our organization. 74% agree that they're critical to the organization's success. Right? So they're not just there, but they are essential. Then the numbers start going down. 58% agree that they're taking an integrated approach, Of course, that means 42% say they're not taking or believe they're not taking an integrated approach. And similarly, 30% say that their organization is sufficiently preparing to manage. But again, that means 70% of, again, a population that says 93% say this is happening and important, right? 70% say, but we really aren't preparing. We're really not thinking about that. And I can kind of tell you story after story related to that. We developed this framework. It's in the report. Basically, what it says is around the outside are the senior people and the decision makers. There are kind of three axes. The main vertical axis is senior leaders and business unit leaders. Human resources and procurement, there's a whole discussion about who has jurisdiction, who actually can tell you how many people in the organization are working for the organization. We have a great story about Nike. On the day of the beginning of the pandemic, tried to figure out exactly how many people were working for them. And to their credit, they wanted to know so they could do the right thing. And yet, it was impossible to figure out truly who had been engaged across the world. How many employees was easy, but how many people were working for the organization was much harder. And then IT and finance legal, you can't have any of these conversations without them. And then the hexagons represent major themes that we talk about: management practices, technology enablers. Clearly, platforms play a huge role in enabling, coordinating, allowing all of this to happen. Integration architectures, to what extent are these various parties integrated, and leadership approaches. And the punchline there is there are a lot of changes for leadership, especially because you end up in situations where you have much less control than you previously had. And I will just flip through these and let you quickly look at them. We developed a maturity index, and we have found that some organizations are much more mature and farther along on this journey than others. And those organizations that are farther along have certain characteristics. And I'll jump to the last one. For example, they align their workforce approach with their business strategy. So the idea being, this isn't just about workforce, but again, the best of these companies, the ones who are on the most cutting edge, think about business strategy in conjunction with what are the resources within their workforce ecosystem that they can leverage to move ahead. And with that, I will hand it back over to my colleagues. I look forward to talking with any of you about this. We continue to look for examples, and again, happy to discuss it. That QR code will get you to the research if you want to take it. So thank you very much.
Thank you. Terrific. That's one of the reasons I come here, is because I learn so much about what's been going on. So over the last, 10 years or so, it's been a phenomenal opportunity to learn. And so what I thought I'd do is, we talked a little bit about the history of what we've been doing at the Platform Strategy Summit over the last decade. But the world continues to change, right? And so what I thought I'd do today is share some insights into what they're calling now Web 3. I don't really have a great definition for you, so what I'm going to do instead today is kind of show you what's happening, and we can discuss, because I think it's an open discussion as to what it is, and is it even worth spending a lot of time on. I think very simply, what is Web3? It's really a rebranding of blockchain. However, it's a little bit more complicated than that, because you get into this whole metaverse discussion as well, which is about virtual interactions and virtual opportunities. And that is kind of interesting, because the blockchain technology is now being married with that and all the interactions that happen. And so my bottom line is that this is all about platforms, because this is all digitally driven. And we know from our experience is that anywhere there can be a platform, there will be a platform, and Web3 will be populated with many types of platforms. So what I'm going to do is walk through what some of those look like and give you some kind of high-level numbers to give you a sense that this is actually getting bigger. So right now, the estimate is about 300 million people around the world hold some kind of crypto. It could be Bitcoin, but there are a bunch of other. In fact, I forget, there's some experts in the room, so I have to be a little bit careful with my numbers, but there's something like 20,000 tokens out there now. And so there's a lot. In fact, they're creating new tokens all the time. Last year, there was just an explosion of what they call NFTs, these non-fungible tokens. So Bitcoin is a fungible token. One Bitcoin is the same as another. But now you can get these non-fungible, which create unique identity associated with a digital asset. And this thing just really took off. And there's a variety of estimates around, this is on the higher end, but about $40 billion worth of transactions associated with NFTs last year. Tons of money flowed into this space. So the estimates are venture capital firms spent $33 billion investing in Web3 startups. So that means if these, not all of them are going to be successful, but some of them are, we're seeing the rise of a new, group of companies coming out of that. And some of the big VC firms like Andreessen and Greylock and others have created dedicated crypto funds where they focus on investing in this space. And there's M&A activity going on. This is just one example. Microsoft acquired Activision Blizzard for $68 billion. And if you read the press around this, was driven by this recognition that gamification, this virtual kinds of activities is going to increase. And so the players are now jockeying for positioning in this. So I don't have the tally for all the M&A activity that's happening in the space, but it's in the billions and billions of dollars. Okay, it's going to transform certain sectors. We're going to have a panel later today with some amazing experts to talk a little bit about the future of retail. So I'll just give you one example, and I think this is a world we know very much. This is Nike. It has its in-store and then its online presence. In fact, Nike was one of the first to really go down this direct-to-consumer strategy. They actually pulled their product off of Amazon to go, and they have a strong enough brand and global presence to be able to do that, and they've invested heavily in building out a platform strategy and hiring platform professionals to drive that. So that's, we understand that world, and they've got beautiful websites with all their products and all this kind of stuff. But they are now moving heavily into this new space. They launched a store in Roblox. In just 4 months, they had 6.7 million people visit that store. Wow, that, from, what was it? Yeah, over 200 countries. And what's super interesting is that some of the retailers are realizing your store doesn't have to be a place for product and price discovery. That's what stores were there for, right? And to pick up the stuff. Nowadays, most people find out about the product and the price before they even go to the store, and you don't even need to get the product at the store because it can be delivered to you at home. So what's happening is now, in their flagship store in New York City, the metaverse environment they created is now reflected in the store. So you're going to the store as a destination to have an experience. So stores are now becoming experience locations, which is pretty interesting. And we're seeing a rollback. In the past, if you wanted to grow your business, you built more stores. You don't have to do that anymore. You're going to build more metaverse kind of environment. So you can see profound transformations happening over the next, and platforms are going to be central to that process. Now, Web3 is highly contentious. There's a lot of debate as to what this is and what's going on, and you can build this into like 2 camps. One are the, I would call the bulls, and they're very bullish. They believe that we're in a period of transformation. The world is going to look fundamentally different, especially when we get mass adoption. And it's going to be a decentralized world. And we're going to be, being able to do direct. We're going to be able to own and control our own data. So a lot of people are excited about this because it's going to break up the position of the large incumbent platforms that now, see it very invasive into people's lives. So there's a whole world of people that really believe in this and are excited about that. On the other hand, there's others that say, no, this is a niche. This is really, the technology isn't really there to be able to achieve mass adoption. And so they're very skeptical just on a technology front, irrespective of all kind of the bad actors that are happening there and the hacks that are taking place. And every year now, billions of dollars are stolen from platforms that offer crypto and NFTs. And so there's that whole debate. And then there's the question of governance. Some people see this as a new way to restructure how governance takes place and allow people to actually vote. I think the quote is that a DAO, these are these decentralized autonomous organizations, are like a community with a checkbook is the description that they use. Others say that this doesn't make any sense. How can you really have effective decision making? There's no way you can create a DAO that's going to be an effective corporation and do the things that corporations do. We're also seeing the proliferation of new ways of holding your information. So wallets, digital wallets are really growing, and so really interesting things happening there. Some people are very bullish on that, and others are saying that, yeah, that's not going to happen so much. Also, the cultural impact. There's been a lot of talk about what they call the creator economy and the ability of creators to participate and get direct rewards. And companies now are exploring, and this goes to Liz's point about what is the boundaries of your firm and who's in your workforce. Suddenly, all these creators can come in and create incredible value, and this whole Web3 space is just ripe for taking advantage of these things. So that's pretty exciting. But others are saying, no, it's full of scams and it's a bunch of rug pulls and all this kind of stuff. So, there's, again, like I said, huge debate over this. And then finally, you have innovation. Some of these people see this as kind of the next phase of the internet, as incredible as what happened in 2020, where you really see, the proliferation and mass adoption of the internet. They see this as being equivalent to that or even more profound. So interesting competing views as to what's going on in Web3. So what I would like to do is, I found this helpful. There's a lot of information about what it is, and it's like, whoa, what's going on? There are these layers, and it's all built on top of the internet. You've got blockchain layer 1. Those are things like Bitcoin or Ethereum, and then you've got these protocol layers that are built on top of them, and then a bunch of applications that are being built on top of those. What I want to show you and highlight is the fact that in this protocol layer 2, in the applications on top of them, huge ecosystems are being built out. And I'm just showing you one, which is called Flow, and this was created by a company called Dapper Labs up in Canada. And it was built because of weaknesses in Ethereum in terms of its speed. And so they are now attracting a lot of companies. They already have 39 marketplaces. And this is just one. If you go through, there are like 19 of these protocols. They're huge ecosystems, and these are worth billions of dollars now. So they're pretty impressive of what's happening. So I think for platform scholars and the people who are interested in the platform world, really watch this space. Because there are these kind of, I would say, idealistic views of interoperability and all these things and how people are going to take their assets in one arena and move it to another. But if you understand the underlying economics of this platform...
Hi, Alex. Can you hear me?
Too much.
Yes, I can. Hi. So we're in the session
Okay.
before you right now.
Okay.
Okay,
So
sound check. So, yeah,
You can see me okay?
you guys need to turn that one off. Anyway, so these ecosystems are emerging. This particular one comes out of weaknesses that were associated with the Ethereum that was built around what they call CryptoKitties. And so they built this new protocol, and it's grown dramatically. NBA Top Shot was one of the first NBA platforms that really took off. Now they've brought in the NFL, so there's really interesting things going on in this space. You also have Genies, and the former CEO of Disney just joined their board. I mean, so there's some heavy players that are coming into this space. This is heavily backed by Andreessen Horowitz. They also just announced a creator fund. What is it, $725 million to attract other, basically, developers, companies to join their ecosystem. And so pretty interesting stuff going on in there. So when we think about Web3, and we think about from a platform perspective, I think there's kind of three groups. One are the crypto exchanges. This is where you can trade cryptocurrencies, and if They aren't holding your assets. You can actually hopefully convert it back into fiat.
Yes, I can.
sometimes.
Can you hear me?
The other are these NFT marketplaces, and there are more than 100 of these now. And then finally, we have the Metaverse platforms, and I'm going to dig into that a little bit to give you a sense that these aren't just little game worlds. They are entire economies, right? So one of them is called Decentraland. They have their own token. That token now is trading, the market capitalization is $1.6 billion. And you can buy land, but you can also exchange digital assets like digital wearables and things. And so there's an NFT marketplace associated with this. Sand is another one called Sandbox, 1.4 billion. I just looked these numbers up, so these are current to this week. And they sell plots of land as well and have a NFT marketplace. And then you have Other Side, which is a brand new one that just launched associated with the Bored Ape Yacht Club. They're building a metaverse. And they just put out a coin, it raised, its now market capitalization is 1.3. So if you just take these three, and there are many other metaverses, these three metaverses have a market capitalization of $4.3 billion. So it gives you a sense of the size and scale of what's going on and the amount of interactions that are gonna happen. And some very big players have bought land and are building assets there. So JP Morgan, HSBC, so financial players are in here as well as other media entertainment companies as well. So I want to talk a little bit about brands in NFTs. So we've seen a number of very big brands launch NFT projects. Lamborghini, for example, launched this pretty interesting one. Just 5 NFTs they put out for auction, raised $650,000. Adidas has had a very successful NFT project, which I think they've partnered with Prada, so the big fashion brands are in this space. They raised $22 million off of a NFT project with a 30,000 mint count. And then Budweiser is also. So it's really interesting here, and it doesn't get a lot of attention, which is marketing is usually a cost center, but if you issue these NFTs, you can actually raise a lot of money. Now there's an expectation that the buyers will get utility from that, so it's not just companies go out there and raise money and they get to keep it. They need to interact, and so then it becomes a platform, and there's a lot of discussion about community and the communities that you build around these projects. And so super interesting space about the future of engagement with customers. This is the automobile industry. So Mercedes-Benz launched an NFT project, and this, kind of the prize here was to win a G-Wagon. And I had no idea how much these things cost, but they were pretty expensive. And there's like $130,000 to $150,000. They commissioned 5 artists to do a bunch of really neat NFTs, and then they had a pretty complicated way that they went out to market. But this did not cost. Mercedes made money off of this because the auction, or not an auction, they did a raffle, didn't happen until $1 million worth of NFTs were sold. So very interesting. Now, this was really niche. If you're a general Mercedes consumer, you probably wouldn't have seen this. It was highly targeted to the crypto space and really marketed to crypto buyers. Big question is this going to go mass market? And so I've been looking at the automobile manufacturers that have done NFT projects. This is not every one of them, but it gives you a good sense of what's going on. There are 2 types. There are commercial projects and then charity projects. So charity projects are things like the Kia America project that was launched around the Super Bowl. And they did a digital collectible, which is this little cute puppy dog thing, which was a robot, which is kind of strange. But the proceeds for that go to Pet Finder Foundation. Another one, Porsche, went to a water company that they wanted to support. Others, it's interesting to watch where the money goes, right? So in the NFT space, you not only find where the money goes from the collector's standpoint, but also where the proceeds go. Some of it sometimes goes back to the company, sometimes it goes to the collector, sometimes it goes to the artist, sometimes it goes to a charity.
Hey, Alex.
So it depends a lot on how the project is designed. And so we're in very, very early days, in terms of how companies, and they're doing a lot of experimentation. Some of them fail. So for example, the Chevy Corvette, which was just 2 weeks ago, they launched it and they didn't have a single buyer. Now, they associated that NFT with a real car, but what do you call it, the reserve price, they set at $250,000. That car is only worth $90,000. So they totally misjudged. So one of the things that is pretty clear is they don't actually have a lot of economists doing demand forecasting to determine kind of what the right pricing is. So in some respects, you can say sometimes a little amateurish because they give it to the marketing department, and these guys are kind of into the cool factor and don't really look at the underlying economics associated with this. So let me close out by giving you some thoughts I've had around ideas that they don't exist today, but they could, right, to utilize this technology. And so one idea is, how do you have an impact NFT that could drive things that an industry is interested in? So right now, the transition to electric vehicles is a big deal for the automobile industry right now. And the question is well, how do you excite buyers, right? So how do you get that new generation, the Gen Z, to get interested in buying electric cars? If you just do advertising on television, you're probably not going to get through to too many. It's like eating your peas, right? But if you issued an NFT that if they arrived at a music festival and got an NFT, if they came in an electric vehicle, and the reward for having that NFT is the ability to get in a VIP section or maybe even meet an artist, because the artists are also under pressure to get greener and do a green. You could attract people to buy an electric vehicle, come there, and it would be really cool if you could actually have them discharge power to actually drive the stages. So that electric vehicle would be part of, and so this is this idea of bringing a community together to contribute work, right? In this case, bringing your green energy to a festival that they want to come to. So I think an NFT, if really well designed, could bring parties together that currently aren't talking to each other. And just to give you a sense of the scale, a company like Live Nation sells 70 million tickets to festivals this year. 70 million. So we're not talking about small scale events. You could find partners that could really drive scale. Another one that I think is exciting and interesting is around digital wallets. Right now, digital wallets are focused on financial or loyalty points, huge opportunities to bring education into the mix and issue certificates of education that could be a way to articulate and reward people and show what they've learned. So we're going to talk a little bit about NFTs and education later today. And then finally, you could also leverage NFTs for knowledge networks and reward people for things around like platform strategy and use the NFTs to buy and sell knowledge, which is pretty exciting. So just to close up, 3 ways to think about it, and I think platform professionals have a huge opportunity to contribute to thinking about how you really take advantage of platforms in exciting and interesting ways.
Right, listen. So, Clay Christensen, who wrote The Innovator's Dilemma, provided one of the most interesting frameworks for understanding how disruption happens. Right? And he was one of the most influential management thinkers in the last 50 years. One of the things that Clay said was interesting is that one of the most useful things you can get is a framework for how to think about problems. If you've got the right framework, then the solutions to those problems become more transparent. So even if you didn't necessarily know the specifics of an individual industry, you could go in and apply that framework and actually get useful and powerful insights. What I'd like to do in the next 10 minutes is to give you the benefits of 10 years of research and see if I can give you one single framework that'll help you solve a lot of the platform challenges. Now, it's fun in a sense. I didn't eavesdrop or get a preview of what Liz or what Peter were going to present. But if we're asked questions about workforce, well, then maybe we're asking questions about structure of organization. Why do platforms have such high market cap with so few assets or employees? Or if we look at the most recent technology, we want to make predictions about what's going to happen. We have blockchain and we have decentralized, autonomous organizations, as Peter was just talking about. And one of the big questions is, are these DAOs going to dethrone platforms? Or why is it that traditional companies that enter platform markets with their traditional strategies fail? Apple, when it came in with the iPhone, displaced 7 incumbents. It's quite extraordinary. It used a different business model, different set of strategies. Or more recently, another interesting example of the same thing in a totally different context. Why is it that traditional antitrust models, when applied to platforms, fail? Right? We are now viewing this with Lena Khan now appointed to the Federal Trade Commission. And what's the new regulation going to look like? I would argue that they have identified the correct problems, but they have not identified the correct answers. So let's see about that. And then more recently, one of the most challenging things we face as a society today is fake news. Why is misinformation such a hard problem relative to platforms? I want to ask you to do a show of hands. What I'll ask you to think about is, how many of you think you could answer these questions quickly and with certainty?
A trend towards asking questions that no one.
I want to give you a single answer that will help you with every one of these. It's a way of thinking about platforms, and see if we can articulate why I think that's true and what the benefit of the research has been. So, pretty much everyone understands the basics of network effects. You attach to a social network, your benefit then brings benefit to another party. Or in the two-sidedness sense, merchants attract consumers, merchants attract consumers, or developers attract users, attract developers. So there's the two-sidedness element of it. The individuals themselves are joining because you create value for themselves. You're getting benefit in that. What's missed in that component is the externality, is the spillover component of it that is orchestrated. To give you an illustration of this, suppose we add governance. So the blue line is an interaction that takes place, but then Google manages your search to then make another person's search better. Amazon manages your purchase to make another purchase match better. So these extra gold lines that otherwise wouldn't happen. Same thing happens again. Another party connects, and then they use that to create an orchestrated spillover for another party. Happens again. You connect two shops, give them the advice. Meituan in China has gotten extraordinarily good at actually identifying for a store what are the missing products sold by other stores, where could they position in high-density neighborhoods that would also bring them value, taking this spillover benefit to third parties. Orchestration requires governance. That's an externality, a spillover benefit handled by governance. That is the incremental value. So again, if you look at this sum in your head, the blue lines, which are the basics, but then what's the value of governance, the value of platform strategy, the value of orchestration is all of the extra gold value that's being created in this. So I want to use that one idea to answer all 5 questions. So take a look, this is a chart I've used before, and this is the ratio. What I really want you to focus on is the ratio of market cap per employee. This is exactly what Liz was telling us about. Why is it so many firms have external workforces? How much do they create so much value? Here, if you compare Uber to BMW, and more recently, it's really fun, recently, if you look at Twitter compared to the New York Times. Now, this is down a lot from where they were, thanks to Elon Musk recently, but Twitter now still has 5 times the market cap of the New York Times. Quite remarkable. What I want to draw your attention to is the final column. If you look at the ratio of market cap per employee, the platform business model ranges from 4 to 27 times the market cap of the traditional firms. Matter of fact, a sample across the entire Forbes Global 2000 shows that platforms versus traditional firms have higher market cap. The average is 21 billion versus 8. Higher margins, 21% versus 12, but half employees. This is what Liz was talking about just a moment ago. Okay? Now, what's happening? The insight here is, again, network effects. The insight is you cannot scale network effects, the spillover benefit, inside an organization as easily as outside an organization. To recapitulate, if this is your employee base, what are your network effects? Now, compare this with the network effects you can create with the entire population. If you were to look at New York Times versus Twitter, The monthly average number of users on Twitter at the moment is over 300 million. Each of these are posting and creating content as opposed to the number simply of journalists that you might have on your own. The insight is you invert the firm. The production of value is not just by own employees. The production of value is also by the external community, but it's also by your governance model where you're figuring out what interaction makes another interaction better, what search makes another search better, what product match makes another product match better, what experience makes another experience better. All of that then helps to explain why production is off the books. And so we're getting third-party production, which is why we see these market cap differences in platform business models. Compare this to strategy. Why does traditional product strategy fail in a platform market? If network effects drive value, community becomes an asset. It's essential you manage the community. And here's another way to think about this. So suppose that you have this technology. How easily can you add the community? Compare that to, okay, you have this community. How easily can you add this technology? My claim is it's far easier to add a technology to a community than it is to add a community to a technology. Let's back that up. Here is a perfect Hewlett-Packard financial calculator. I paid 99 cents for it in order to not have ads on it, okay? What's interesting is I asked the question, how easily could Google displace Hewlett-Packard? Trivial. They did it without even trying. A third party did it. Now, compare that with how easily Hewlett-Packard could displace Google. That's bloody hard, okay? So what I'm going to argue again is it's easier to add a technology to a community than it is to add a community to a technology. Once you see that, once you start to orchestrate network effects, your strategy model changes. Because you're not protecting the assets, you're now actually protecting and building the community in it. To summarize, if you take the Porterian view of the world of 5 forces, you have distinct forces. You focus on the supply side economies of scale. You own and control the inimitable assets. Innovation is done by the firm. And you create barriers to entry, keeping others out, and boulevards to exit, because you don't want the competition. You want to fatten your margins. Just doesn't work in a platform world. Here, your consumers can become your producers. Your competitors can even become your complementers, bringing them onto the platform. If they add unique sources of value and you control the information flows and you control the monetary flows, then they are adding to your ecosystem. The scale economies are the demand side. These are network effects, and they will protect you every bit as much as the supply side economies of scale. Your asset now is the community because the community brings resources, as I just showed you. So you're not just valuing the assets of the firm, you now have to value the assets of the entire community. Innovation occurs by the ecosystem. So if this is the slope of your innovation of your own R&D department, now add the ecosystem and you do this, and guess what? You've got a higher slope. You have to win. It's just a matter of time. So that's a huge difference in the innovation business model. Most importantly, you focus on permissionless entry. Amazon wants as many merchants on its platform as possible. Uber wants as many drivers on as possible. Airbnb wants as many hosts as possible. Google and Android want as many developers as possible. That's permissionless entry, a production consumption, and not barriers to entry to competition. You must think differently. What about antitrust? This is what the federal government is dealing with now, and they're getting it wrong. Okay, but let's take a look at traditional tests. All right, so I will argue that antitrust right now, they're getting it right in terms of identifying the problem. So I agree with them, there are issues that need to be dealt with, but their solutions are not the correct ones. So how do you define market share dominance? Is market share high and abused? Well, problem number one is, what the hell is your market? Amazon, are they in books, cloud, e-commerce, home devices, groceries? Is Alibaba in e-commerce, health insurance, payments, banking, movies, logistics? Is Google in email, search, maps, home devices, self-driving cars? We've got a market that's really hard to define. What about restricting output? We teach in economics that When you restrict output, you move from monopoly to duopoly to oligopoly to competitive market. So restriction is what you do in order to control that marketplace. Google restricting your search? Is Facebook restricting your posts? Is Alibaba or Amazon restricting your purchases? Of course not. And what about pricing? The standard model is the snip test, a small but significant increase in price. That says you're gouging because it's above, you have market power. You're above marginal cost. Or maybe you're below marginal cost because now you're doing predation. You're going to drive your competitors out and then move your price up later. But in platform markets, the price is often zero. So those tests you have to throw out the window. Those don't work anymore. Why? You're subsidizing one group in order to then make value on another group. If you understand the platform business model with network effects and the inverted firm, all this has a different version. Of course, it's hard to define the boundaries when third parties are creating the value, bringing you the apps and the devices and the books and the merchant sales. Of course, they're not restricting the output if zero marginal cost because third parties are doing it, and every increment adds to your bottom line, no matter who it is, because you're getting a transactions cut from their participation. Again, it's production outside the firm. And of course, some of the work Jeff and I did on two-sided markets, the two-sided pricing, you're giving stuff away to one market in order to grow the size of the other market and charge that market, which explains the failure of the snip test. So again, externalities help to explain, and the inverted firm help to explain that concept. This one's particularly pernicious. What about misinformation? Okay? All the other things we've talked about so far are positive externalities, positive network effects, one party creating value for another party. The problem with misinformation is there is a negative externality. There's damage occurring off-platform. The damage occurs when anti-vaxxers are causing us to lose herd immunity on the one part. That's damage off-platform. The damage happens when conspiracy theorists cause a pizza parlor to get shot up. That's off-platform. Or the damage occurs when misinformation causes insurrection. Again, damage off-platform. They're driving engagement on-platform, but there's all the damage that's being shed. Now, what's happening? If you understand again that it's externalities driving the phenomenon, externalities cause market failures. Market failures require intervention. Government intervention in the case of speech is expressly barred by the First Amendment. That's why this is such a hard problem. We do not have institutions for dealing with negative externalities that would have to be done by the market. Markets do not self-correct market failures. So we have to design new institutions to address those kinds of problems. But here's the explanation for the phenomenon. So what about prediction? What about decentralized autonomous organizations? We've got blockchains. We've now got new business models built on these methodologies. Can decentralized autonomous organizations dethrone platforms? Well, what's the argument that's being made? The first is blockchain technology and DAOs can remove middlemen and transactions costs. Sure. So these middlemen would be charging too high fees in banking or what have you, and so they will be minimizing the transactions costs in that, and you might think that that could do some displacement. That's only half the story. The other half of the story is, again, the positive orchestration of externalities. DAOs that lack governance, the purpose of which is to create the gold extra value beyond the blue lines, cannot happen if the only thing you do is decentralize. You have to have governance to deal with the positive externalities, to create them, to cause them to happen. Whether it's a positive externality or a negative externality, you need to create it. That is a design task. So the point is, the DAOs that don't have governance will never displace the platforms, and I'll bet $1 million on that. If they add governance, then it's possible for the DAOs to make. So some cases of adding smart contracts, some cases of adding DAOs that do implement governance up, then those could potentially be a threat with very interesting new implications. But what this tells you is not only the ability to predict, it's the ability to control. Because now you can design those features in and then actually make markets move. So To recapitulate, again, one single idea. Why do platforms have such high market cap with so few assets? Network effects drive inverted firms. This means that you harness external producers and assets not counted on balance sheets because it's a different structural form. Strategy. Why does traditional strategy fail? Well, network effects mean community is the key asset. You want community permissionless entry, not competitors' barrier to entry. And that's why that is so different. In regulation, network effects increase in scale. You want to spread it over bigger and bigger populations. So the traditional interventions of splitting it to create competition and dividing the assets ruins and destroys value. That's where the FTC is getting it wrong. Now, there are design ways to solve that problem, but they don't understand the issues underneath it. Then the next one is fake news. Why is that such a hard problem? Again, it's a market failure, but this time born of negative externalities, not positive. And intervention in speech markets by government to solve that kind of market failure is barred by the First Amendment. We need new structures to solve that problem. And if you want to predict the future, are decentralized autonomous organizations going to succeed or not? Ask the question, do they implement governance? So if they don't have governance, I can guarantee you they will not displace platforms. If they implement governance, then it's an interesting challenge. They very well might, because they've understood the design problem. They've understood what the challenges are and how you win. So my goal here today has been to give you one simple idea that helps you do all these different things. Understanding network effects, not just attachment, but intentional design, building it into the governance model, gives you the power to explain what has happened, to predict what will happen, and then even to control that outcome by doing the acts of design that will actually bring them about. So just to give you a quick summary of that, so this is the research that we've been doing at MIT and Boston University for the past decade. We can actually give, if you want the answers on how to do that design work, these slides will be available online, but we can tell you about how to design the data rights, how to do the strategies, how to deal with fake news, how to implement antitrust, and for the business audience in particular, how you can work with labor, how you can work with strategy across these different points. So this goes back to decades of research, but very happy to actually have all of this stuff available online. So with that, I think we are slightly past, but I think we're going to try to take a few questions. We'll take one or two questions from the audience if you have any. So a quick hand.
We also have, of course, our online audience.
So a quick hand in the back.
Can you come up to the microphone? So Marshall.
Great presentation, thanks. Is this on?
We hear you.
Okay. Yeah, maybe we want to challenge your fifth point, because I would say, I mean, a DAO without governance, just a Discord channel, and I would say that platforms and DAOs will go very well together. So, I mean, you probably know brain trust, right? Like, users having the ability to inform, design decisions and this kind of stuff. So I would not, like, what's your point on this, like combining DAOs with platform versus DAOs replacing platforms?
So you need a DAO with a governance model, at which point it really becomes a platform. So it's just a different, what that happens is, actually, let me answer your question by answering another question, okay? One of the first questions coming up from an audience is, how do you define a platform? So to give you a simple definition, a platform is an open architecture with rules of governance to facilitate interactions. The blockchain is then simply the open architecture on which it's implemented. But it's the rules of governance by which you actually design and propagate those externalities by design from one party to another. So when you add the community and you do that correctly, then you can actually implement the rules of governance so that one set of interactions makes another set of interactions better, which gives you the positive feedback. Users create value, which attracts users, which creates value. And the more you can do that, the higher the production rate of positive externalities and the mitigation of negative, the more that's likely to take off. And so that's the way to make that happen. Okay. Do we have time for
Let's
one
just
more?
take one more, yeah.
One more question. So there's one from online. I don't know if there's one more question here. There's one more. This may be, I think this one's for Peter. In a pro-crypto world, do Web3 platforms overtake traditional platforms, or do both coexist in very market use cases? So I don't know, Peter, if you want to take that one.
I think that's the big question. I think the proponents, the bulls I mentioned before, would like to see that and see Web3 as a vehicle for basically undermining, and those, some are very skeptical that that's going to happen. But I should say that if you watch hiring, Google and some of these other big platforms have started to put out job postings to create their own units internally. So they're looking at this, they have a lot of resources, they're gonna be part of this game.
So I think we're at time, and I think many of us have heard Andrew Ng is online, so we should actually get started with the 10-cent presentation next. So that's a really, really outstanding set of issues. So, and again, thanks,
Okay,
to the panelists.
thank you.